Welcome back. The Reserve Bank of India cut the repo rate by 25 basis points, which will impact banks because of the loans linked to repo. This may actually be at an advantage for NBFCs because they borrow from banks at loans linked to the repo rate. Now, to discuss the full impact of the Reserve Bank's various policies, as well to discuss the key takeaways from the Q3 results season, which for the banking sector has just ended with SBI announcing late last week, I have with me banking expert Suresh Ganapathy, Managing Director and Head of Financial Services Research at Macquarie Capital. Good morning, Suresh. Thank you very much for joining us. First up, at the end of the policy, do banks look far better?
Yeah, definitely. The fact that the RBI governor very clearly said that some of the implementation of the norms like LCR and ECL could be at least delayed for a year gives them a little bit amount of breathing space. And the fact that you have, of course, cut rates and the kind of liquidity infusion which has been done clearly means that at least next year things look to be slightly better on the liquidity front. And therefore, as an overall financial ecosystem, I think the policy was a step in the right direction. An overall positive, I would say, for the entire financial system. Of course, we'll come to implications of repo rate cut on banks, but I would read it pretty positively.
Okay, no, if you can make it bank-wise, I mean, who gets hit more because they have external benchmark-linked loans, or who get advantaged because liquidity, at least the governor's promises that he will keep it plentiful, who would have gotten impacted because of LCR rules?
Definitely, the LCR rules are going to impact the private sector banks more positively because of the fact that they have been running at a very high levels of LDR, and in general, the liquidity tightness has been there in them, and therefore they, of course, also have been growing the balance sheet much faster than the public sector banks. I'm talking about both on the loan growth and the deposit growth. So any relaxation on that front is going to be positive for the private sector banks. A relaxation on the ECL front actually is positive for the public sector banks. As far as the repo rate cut is concerned, Latha, I think we have to understand that the entire rate cut cycle itself is going to be a pretty shallow rate cut cycle. So to that extent, the benefits that you feel would accrue to the NBFCs because of a falling rate environment, or conversely speaking, the fact that the margins could be under pressure because of a cut in the repo rate is actually slightly exaggerated, because what we are talking about is a cumulative maybe 50 to 75 basis points cut in rates, and that too will happen in stages. And roughly what happens here is that the total MCLR, we also have to consider MCLR because eventually that also will be cut. So both repo plus MCLR roughly put together is anywhere between 65 to 70% at a broader system level, with PSU banks slightly at the higher level. So while there could be, to some extent, in our view, anywhere between 10 to 20 basis points compression in margins next year, it could also be offset by the fact that Latha, loan growth has been pretty weak. Unsecured loan growth has been running at about 10-odd%. That will go to 15-16%, thereby cushioning the margin. So net-net, if I were to really look at the different drivers of margins, I don't expect more than 10 to 15 basis point compression in margins for the sector because of the RBI's cut in repo rate.
Okay. All right. Get that point. It will be countered. You know, the SBI chairman spoke to me after the policy, and he thought that deposit rates are not going down for at least a couple of quarters. Definitely not this quarter. It may take even longer, he thought. Right. So, you know, therefore, the negatives will come first for the banks before the positives come. Let me get to the results season as well. You know, now that all the numbers are out, would you want to think back and say which ones stood out for you? I mean, in terms of deposit growth, for instance, now on hindsight, HDFC Bank's performance looks very good. You know, SBI has been able to manage only 9% or 9.3%. HDFC managed big double digits, you know, 16%. High teens, 18%. Yeah. So anyway, looking back, what stands out in terms of performance?
Yeah, so let me try to split in two parts. One is, of course, the overall balance sheet growth perspective, and also obviously with respect to the asset quality front. I mean, look, very clearly the public sector banks still continue to have exceptionally low levels of credit costs, right? I mean, if you look at SBI and BOB's numbers, you're running at really low numbers. SBI was at about 23 basis points for the quarter. whereas the private sector banks are anywhere between 50 to 75. So on the asset quality front, the public sector banks are clearly outscoring because the component of unsecured loans in them is much smaller compared to the component in case of private sector banks. But the area where the private sector banks are doing really better compared to the public sector banks is on the balance sheet growth perspective, specifically on the deposits front, where clearly the public sector banks continue to lose steadily the market share. And again, another area where the public sector banks are not doing as well as the private sector banks is very clearly on the margins front. Now, the reason why this is important is because, as you know, the repo has been cut. So there is a downward bias to margins, although I say that it's going to be limited. But even at really rock bottom levels of credit cost, the ROAs for the private public sector banks at best are at 1%. So the real problem here is once the credit cost starts normalizing, with a slightly downward pressure on margins, clearly the ROAs for the public sector banks would be at a greater risk compared to private sector banks going forward.
Okay. What would you say is the impact of the budget? See, we are talking about margins. That is the price per loan or the profit per loan for a bank. But won't the number of loans increase because every one of us have about 60,000 to 1 lakh rupees more? So won't you, if you're planning an EMI of, say, 90,000 rupees, you will push it to 1 lakh because you have 10,000 more. You don't see loan growth. After all, isn't 11% loan growth a nadir?
Latha, in that 1 trillion rupees, people will eat pizza, people will buy a lipstick from Nykaa, people will buy cars, people will save money.
No, I'm just asking whether loan growth numbers you are, pushing up.
Yeah, I mean, look, let's put it this way, that if the constraint for the loan growth in the near term always is going to be deposit growth. I know the economists argue that it's loans that create deposits and all those stuff. But at the end of the day, we also have to understand that the Reserve Bank of India has been to some extent, at least till last year, was shrinking the balance sheet. Yeah. Now, of course, they have cut the CRR. So there will be a money multiplier. Money multiplier, as you know, is 5 times. So a 0.5% cut in CRR will have a 200 basis points improvement in deposit growth. Of course, you've started doing OMO after, 3 years, 4 years. So there is obviously an expansion of the RBI balance sheet, which will have a better deposit growth. And eventually, the loan growth should also be better. I mean, the Reserve Bank of India governor very clearly also told about the fact that he's comfortable with the current growth in unsecured loan growth. And that need not come down. In fact, on the contrary, the unsecured loan growth can go up a little bit further. So the way we are looking at here is, we are at around 11% loan growth and 11% deposit growth so far. We will end the year with almost similar numbers. Next year, at least, we expect 200 to 250 basis points better loan growth, driven by some of these consumption-related aspects. And also, at the end of the day, the deposit growth should also be relatively better by 200 basis points. You're looking more like a better 13% kind of an environment next year compared to 11% this year.
Okay, so as a bottom line, looking at the results so far of the banking sector, and the budget and policy takeaways, what is your order of priority in terms of bank buys?
Yeah, look, so FY26 will continue to be a better year, in my opinion, compared to FY25, despite the margin compression because you have a better loan growth, better liquidity environment. And credit costs, at least for the private sector banks, second half of next year should start coming down, because all signals are pointing towards almost plateauing or peaking of the unsecured loan stress, right? So somewhere down the line, a couple of quarters, we will see a decline in the credit cost. So my picks very clearly would be a little bit more biased towards banks over NBFCs, and within banks, the private sector banks. I mean, some of these guys are only trading at a very attractive level of valuations on an FY27 basis for a 16-17% kind of an ROE. So I would follow a little bit amount of a barbell approach here, Latha. So on one hand, you can have really good quality ones like the likes of HDFC, ICICI and Kotak. And at the other extreme, you can really go for a low valuation bank or an NBFC like IndusInd Bank or Bandhan Bank, which are trading well below book. And you know that next year, at least the unsecured loan cycle should be relatively better, including the MFI space, compared to what we have seen so far this year.
Okay, got that. But why are you saying banks over NBFCs? Wouldn't NBFCs find wholesale borrowings cheaper? After all, sovereign rates have crashed.
Yeah, but you have to also understand, Latha, that the overall quantum of rate cuts itself is going to be limited. So while when rates went up from 4 to 6.5%, On the way down, we are looking at 6.5% coming down to 6, and NBFCs borrow 50% from the banks, right? So the extent of benefit that the NBFCs are going to receive on the cost of funds, this cycle will be limited is an important point which we want to drive across. And secondly, Latha, I do believe that the growth this cycle for the NBFCs, specifically on the consumer retail front, would be relatively lower because gone are those days when you grew 25 to 30% when unsecured loan was growing at 30%. While unsecured loan growth will pick up, you're not going to go back to the 25 to 30% kind of a range. So you're looking at a slightly lower loan growth environment in the next 2-3 years for NBFCs compared to what you saw in the previous 3 years. So those are some of the two important considerations which makes us a little bit more guarded on the NBFCs compared to the banking space.
Okay. I'm not getting to the insurance because it's another vertical and I'll invite you on another day. But if you can speak about fintechs, Paytm, PB Fintech, actually that's a category by itself. And then you have even small finance banks, the ones that we didn't discuss. Anything in that space that looks good? I mean, grow the whole range of fintech.
Yeah, see, PB Fintech, of course, is corrected quite sharply of late, yes. And their numbers have been pretty strong. I mean, they clearly have a path towards profitability. You can see that in the strong revenue growth numbers and also in the operating leverage numbers. While we do have an underperform on both Paytm and PB Fintech, I think there are, of course, some of these companies who trade at a very high level of valuation. So if we were to keep the valuation aside and purely focus on fundamentals, we do believe PB Fintech is slightly better. See, the problem with small finance banks, I do believe here is the fact that the deposit growth environment still looks tough. So I think in an environment where I would take a call that deposit growth benefits that will accrue more to a private sector bank than to a small finance bank who have been either to relying heavily more on the bulk deposits market. They do have a large microfinance exposure. A couple of them may not be having that much. But remember that there is now a big question mark with respect to the business model itself in a way that do you need to structurally pivot away from microfinance as a business segment? Because gone are those days where you used to have one bad year and 3 good years. Now it's looking like a one bad year, one good year. If that indeed is the case, you have to go more towards secured segments, which means lower growth, which means lower margins, lower profitability. And therefore, there is clearly a pivot of the business model. And that recalibration makes us a little bit more worried on the small finance bank as a space itself.
Fair point. No, I take your point. I believe even, there were news reports that the regulators worried, but I couldn't check it personally. Very quickly, top finance sector buy for you.
Top finance picks, you mean to say?
Yes, pick.
Yeah, so it would be, as I said, HDFC, ICICI and Kotak. I'm sticking with the quality names at this point in time.
Okay, sticks with quality. Unfortunately, out of time, Suresh, always a pleasure having you with us. And thank you for this many splendid analysis of the financial sector. We have to wind up on Bazaar with the note that mid-caps are under serious pressure. And the pressure on even the big ones is not abated. It's still 0.75 down, a little better than 0.8 down. But really no relief coming up on any part of the market just yet. Wrap up on Bazaar on that slightly somber note. Hope Chartbusters, when it takes up the action, will have better news for you.